Yo, what's up, everybody? It's Thursday, September 19th. Big day, big day in the market. Actually, today was the day that I thought we were going to see yesterday. Because I said yesterday we had the rate cut and then we had a Social Security payment. So the system was really primed for a big up day. And we closed lower. But today we just shot up right from the opening overnight, actually. And yeah, I said there was going to be some more of this. It's going to take a little time. I have to tell you that everything, first of all, I don't like doing these day to day. What's the reason for this? What's the reason for that? I think it's a very bad habit to get into because it creates a kind of dependency where, you need to know, or somebody needs to know every single day, like what's the reason for this happening or what's the reason for that happening. I've been over this many times where, it's just not something that you can necessarily put your finger on. I mean, it could be emotional, it could be a headline, it could be some big fund or market player adjusting a position. Not that I'm not saying that was the reason for today, but it's not a good exercise in mental game to try to explain every single day what's the reason why it goes up, what's the reason why it goes down. I try on these videos to help you guys train your mind for the big picture perspective. Okay, that's why I always talk about, I've been talking about these rate cuts and how they're going to end up being a contraction or a reduction in the interest income transfers. I mean, that is, I said from September 18th, which was yesterday, that is the beginning of a change in fiscal and monetary conditions. Something that we haven't seen really since, when was the last rate cut? It was 2020, I believe, so 4 years. And we've been in this rate increase environment since 2022, where I told you how it was going to play out. I said it was going to be very positive for the economy. I said the stock market was going to make all-time record highs. I said the interest income transfers were going to be gigantic. I even predicted or forecast the point in time where the Fed ran into a situation where it had negative equity, where it was paying out more on interest on reserves than it was earning on its balance sheet. I said that. Not only did I say that was going to happen, a couple of years ago, I said years ago, I don't know how long some of you have been following me, but I said years ago, there's going to come a time when the Fed raises interest rates where it would put them into a negative equity situation. And that happened. I said, I don't think necessarily anything monetarily is going to come of that. I said it could be a political issue if Congress sees that the Fed was not able to transfer its annual earnings back to the Treasury. But it didn't even end up to be a political issue. But I told you that like way in advance. And I'm telling you 2025 already, with the caveat that if there's not a fiscal offset in 2025, we're going to see a slowdown. We're going to be in a recession. Last year, when everybody was saying there's going to be a recession, I said there was going to be no recession. So I like to have the big picture. I always kind of give the anecdote or the analogy of, you're flying over Manhattan at a 30,000 foot altitude, and all of those big skyscrapers, they look like little tiny teeny things. But if you owned one of those skyscrapers, you'd be a very wealthy person. You got to reduce things down, and the only way you can do that is through perspective. And that's by stepping back, that's by slowing down, calming down. I talk about a lot now about my boxing journey, which I'll call it my journey, okay? I'm new to boxing. Like, I've been doing it for not even a year, 11 months. In October, it'll be a year, okay? And one thing that I've had to learn, and it's been hard, I'll be honest with you, is I got to slow down. I got to have patience, especially when it comes to sparring. Well, absolutely when it comes to sparring. When I'm in there in the ring with an opponent, my instinct is to go all crazy, to go all out, and you just gas out. I don't care how good your cardio is. That is not a good tactic. That's not a good strategy. You gas out. You got to learn how to pace yourself. You got to learn defense, okay? You got to learn how to make your opponent come to you with openings that you can exploit. And all that is about stepping back, taking your time, waiting, being patient. I've talked about in the past, being that crouching tiger in the jungle, waiting for your prey to come by and jump on it. There's not something to do every single day. Like a lot of you know my background. I've talked about it many, many times on these videos where I spent years on 4 different futures exchanges as an independent trader, every day trading thousands of trades a day, in, out, in, out, in, out. I made money, I lost money, the experience was incredible. I would not change that for anything. It doesn't exist anymore, and I'm very happy that I got to experience that. It was great fun. It was unbelievable. The atmosphere to be involved in that kind of crazy job. It was just unbelievable. But it was not a big way. It was not a way to make big money. The big money on the floor, I could tell you right now, the big money on the floor was made with guys who were hooked up in one way or another, either with big brokers executing orders where they got the edge, or, some kind of shenanigans where they were, back in the old days, you were able to cross your orders against your customers' orders. And it was like, that wasn't even done in the pits. A customer had a buy order, you would sell it to them outside the pit at a higher price. Then you would go back into the pit and cover it, or you would cross it with another customer order, okay, that had a sell order. It was crazy. I knew guys that made fortunes doing that, but that was back in the bad old days. I don't encourage any of you to latch onto this short-term mentality. I do encourage, and what I try to do here, number one is education, MMT, and understanding the monetary system. But number two is to try to instill the habits and the behaviors that are going to, take you to where you want to go over a period of time, the long term. And that's, building wealth, amassing wealth, accumulating assets, good assets, having patience, having discipline, having good mental game. All right, let me talk specifically about what's going on in the markets now. I think there's still upside momentum here, okay? We see the very emotional reaction today off of the rate cut, which I thought should have happened yesterday, but it doesn't matter. It's still got momentum. It's going to continue. We need to follow now, or I'm following now, those fiscal flows, the interest income transfers that I've always been talking about. And I said the first place where it's going to show up, the first place where it's going to manifest is in the discount on treasury bills, which is functionally, that is the interest rate paid on treasury bills. We just had an auction today of 4-week and 8-week bills. We're going to start to see within, I think, a fairly short period of time, a contraction or a slowdown in those interest income transfers with respect to the T-bill discount. And slowly but surely, don't forget, folks, when the Fed started raising interest rates in 2022, in March 2022, there was a period of time where the market was going down because, number one, it was, again, this reflexive reaction on the part of monetarists who think that rate increases are automatically and always negative. Okay, there is some kind of accounting reality to this where, they have to discount forward future earnings and stuff like that, future cash flow. Frankly, I think that accounting method and the assumptions used in that method is flawed. That's my own personal view, because it doesn't take into account, it's kind of like a gold standard, the mentality, those formulas. I think that's intrinsically what's built into those things, but that's my own personal view. I could be completely wrong on that, but that's what I see. Okay, they don't really account for, like in the case of the interest increases, the rate hikes, they don't really account for the increase in economic activity because of the income transfers that go into the economy. They just look at it from the debt side. And I always talk about this. I say that's the single variable analysis. So there is an initial reaction, and there is an initial reaction with the rate cuts in the same sense. It's an accounting reality or an accounting phenomenon, let's call it that. But in reality, and what I've been trying to explain to you guys, is this reduction in fiscal flows. And that's the key. I've said so many times, and I hope you realize this by now, maybe some of you don't, but I said so many times that fiscal flows are the first derivative of all economic activity, including bank credit, okay? Fiscal flows come first, okay? When fiscal flows are reduced, bank credit tends to expand to the degree that it can, because households and firms tap into credit when those flows are not going into the economy, and vice versa. When those flows are going into the economy in a strong way, you actually see a reduction in bank credit. And we saw that very, very clearly in the pandemic when we had massive stimulus from basically nothing. We shot up like huge amounts of stimulus. Loans and leases contracted, bank credit contracted. Why? People didn't need to tap into the credit. They were getting checks from the government. And checks from the government don't come with an offsetting liability. Like if you get a Social Security check, if you get an unemployment check, and they were handing out money for all kinds of things back then in the pandemic. So people were like paying down debt, and you actually saw the credit base shrunk. So it's very, very clear. All right. But I think there's still momentum here. We're going to have to wait until these interest transfers start to, really contract. You're going to see it show up in the economic data. And again, I'm going to repeat, maybe some of you are going to roll your eyeballs. You're going to think, he keeps saying the same thing. I'm sorry, but that's how we learn, through repetition. The stock market is going to follow the economy, and the economy is going to slow down. And I think it's going to go into a contraction by 2025, maybe even sooner. We'll see. So enjoy this while it lasts. If you're in the stock market and you're looking at your account every day, your Schwab, your TD Ameritrade, whatever it is, and woo, it's way up. Fantastic. Good for you. But just be a prudent investor. Keep cash handy, because when it goes down and when everybody is puking it out and when everybody's freaking out and they're selling, and believe me, I've been through so many cycles of this. I remember back in 2022 with the rate hikes, and I had subscribers saying, I can't take it anymore. That's it. I'm selling out. It's just going to keep going down. It's never going to stop. And you know what happened, right? It did stop, and it went all the way back up. And they sold out at the bottom because they're emotional. They lack discipline. They got in when it was high. Then when it went down, they look at their numbers, not thinking long term. It's very simple. It really is very simple. Anyway, that's it for today, folks. Please like and subscribe the video if you choose to. Thank you very much if you've already done that. And don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. See you tomorrow. Bye.